For today's session, we have Shahar Ziv joining us. Shahar is the co-founder of the Harvard Personal Financial Management Wintersession course and is thrilled to be back to teach the program for the 11th year. He is a graduate of Cornell and Harvard Business School, and he currently works at PayPal as the Vice President of Strategic Initiatives and Operations. He's a contributing writer for Forbes and serves on the board of directors of the Harvard University Employees Credit Union. I'll pass it over to you, Shahar.
Thank you so much. And hi, everyone. Really, really excited to be here. Wish we could be in person, but we will make it kind of as engaging virtually as we can. And thank you for taking time out of kind of the end of your winter break to join. I think this is a really special program that has been running in a great way to learn some of the basics and beyond around kind of financial health and really set yourself up for short and long-term financial success. So today I'm going to focus on an intro to investing. And as Sarah mentioned, feel free to ask questions throughout anonymously. I won't call out names using the Q&A feature. We'll try to leave time at the end. So first I just want to talk about why you should listen to me. I've been doing this for a long time. I finished up business school across the river from where a lot of you are in 2011. And since then, I've been coming back every year to teach this. Since then, have been teaching students across a lot of other schools and a lot of other employers. Really, really passionate about it. I like to teach, I like to write, and I like to speak about it. But the most important thing, especially for the investing section, is at the bottom. I am not affiliated with an investment management firm. I'm not trying to get you to invest money with me. I'm not trying to get you to do your, for me to do your taxes. None of the companies or products that I'm going to mention today in any way give me any type of compensation for mentioning them. And so I am as unbiased as you can probably come with this area, and I don't have any conflicts of interest. And that is probably the most important thing I can emphasize on this slide. Lots of people out there have your best intentions at heart, especially while you're in school. Afterwards, a lot of people will still have your best intentions, but some may not. And some may have conflicts of interest. They may recommend certain investing products or services because it's more beneficial for them than it is for you. And so the reason I highlight this is the first lesson for investing is you want to ask yourself, does the person giving me advice have any conflicts of interest? Is there anything that would cause them to give me advice that's not in my best interest? And so I like to highlight my objectivity, but also use that as a first lesson for all of you for now and forever going forward. When you're getting any type of financial advice, ask yourself those questions and be a little bit skeptical at first of the person giving you advice. All right, with that as a backdrop, just to set expectations. Some of you may know person on the left or on the right. On the left is Warren Buffett, famous kind of head of Berkshire Hathaway, one of the most prolific investment management companies out there. On the right is Mellody Hobson. She's the founder and CEO of Ariel Investments, one of the most successful investment management companies out there. In the hour that we have, I cannot turn you into either one of them. Instead, the goal is to give you some basic kind of tools and help you build a toolkit for you to think about how you should start to invest. We will not be able to kind of go into too much depth on a lot of these. We could spend an entire week or frankly a month talking about investing, but this should be able to give you some practical insights and rules of thumb that you can carry forward. So with that, let me start with the end in sight, which I know they don't do in any of your classes, which is what is the secret to investing? Well, before I tell you what the secret is, let me tell you what the secret is not. And the secret is not to invest everything in GameStop. If any of you have been following, kind of the current events for the past year, there were a lot of fun memes going around where some people made a killing on GameStop, but more lost a lot of their life savings on it. But the real secret to investing is probably the most counterintuitive thing that any Harvard student has ever heard. And that is be average. That is the actual secret to investing. Now, for many of you, you're starting to look at me very skeptically because this is not something that I'm sure many of you have heard. Your parents didn't come and say, be average, aim for mediocrity. In fact, the way you've gotten to where you are today is by being anything but average. But when it comes to investing, the key to long-term success is to be average. And here's the paradox. By aiming for average, you will most of the time end up above average. Now, that's easy for me to say. Let me actually give you a good example of this. So we talked about Warren Buffett, one of the best investors of all time. Warren Buffett's advice to 99.9% of the American population is invest in average, kind of mutual funds. Basically, he says, don't try to beat the market, invest in plain vanilla index funds. We'll talk about that in a little bit. Basically, average funds that all they do is try to mimic what the stock market does. And he basically said, I am so confident in my guidance that I will put up $1 million of my own money against any person or company that wants to take a bet. I will put money into the most average of funds, and other person company, you can invest in whatever you want. And as it turned out, there was a company, a hedge fund called Protege Partners, that took Buffett up on this bet. Now, the good part is the $1 million was going to go to charity, so it was a win-win. But obviously, I'm leading you a little bit, but as you may imagine, after 10 years, the results weren't even close. Warren Buffett invested in what's called the S&P 500. It's basically, part of the stock market that looks to track a combination of portfolio of a lot of different companies. And after the 10 years, he was up over 125% on the money that he put in. Protege invested in 5 different index or kind of hedge funds, and you can see the returns of each, but the weighted average return that they had was 36%. So not even close, not even half of what Warren Buffett did. So again, aiming for average often gets you to be above average when it comes to investing. If you take nothing else away, remember that. Aim for average. So with that, let's kind of dive in a little bit. So investing overall is crucial because it basically helps you to stay ahead of inflation and really is the best vehicle you have to grow wealth that you start to accumulate. If you look at kind of interest rates right now on a checking account or a savings account, and if you look at it over the past kind of couple of years, they've fluctuated, but probably haven't gone above 2%. Often. Bonds, which are essentially IOUs that the government or a company issues to investors, have returned a little above inflation, about 1% above inflation over past 100 and some odd years. Inflation, which is in the news these days, in 2019 it was 1.8%. In 21, it'll be in 22, maybe a little bit higher. That actually causes your money to degrade in value. If you were paying, $1 for a gallon of milk, and if there's a lot of inflation, that gallon of milk is going to cost more money. And so, unless you're doing something to actually earn more money, you won't actually be able to buy that same gallon of milk with that same amount of money. The only real way to really trounce, inflation and really grow wealth is through investing in the stock market. And you can see there that even after adjusting for inflation, the S&P 500, one of the main kind of indexes for stocks, has outperformed by averaging about 8% annual return each year. So investing is critical to helping you kind of grow wealth that you start to accumulate. Here's another example. If you had invested $1,000 in 1915 in stocks and another $1,000 in bonds, in 2014, that $1,000 that you invested in bonds would be worth close to $3,000. You almost tripled your money. Pretty good. But if you had invested $1,000 in stocks, you would have $2.3 million in 2014, orders of magnitude more. And so again, just another way of showing that over the long run, stocks are going to be your best way to really generate and grow the money that you have. So with that, let's start to get a bit more tactical. And I have a kind of a more of a theoretical question, and feel free to type your answers in the Q&A. So imagine you're walking down kind of Brattle Street one day, and you see a penny, and you pick it up. Now, this is not an ordinary penny. It's a magical penny. And the reason it's magical is that it doubles in value every single day. Meaning on day 2, you have 2 pennies, then you have 4 pennies, and then you have 8 cents, 16 cents, etc. How much money do you have on day 31? Any guesses? Let me finish this piece and I'll come back to a question that was asked in a minute. Any guesses on how much money you have? I'm seeing a couple in Q&A. All right. Some of you may be getting out Excel or trying to use a calculator. So let me kind of help out here. On day 31, you would have $10.7 million. 1 penny in a month grows to $10.7 million. It's a lot of growth. Now, here's another question. Imagine that on day 1, you were walking on the street and you missed the penny. You were too busy texting or looking at social media and you just walked right by it. But imagine you picked it up on day 2. How much money would you have at the end of that 31-day time period? You know, the answer is still a lot, but not as much, $5.3 million, which coincidentally is the same amount that you had on day 30 if you picked it right away. Last part of the thought exercise is, imagine you were so busy and so glued to your phone that you didn't notice the penny for 10 days, and it took you until day 10 to actually pick up the penny. How much money would you have on day 31? And the answer is $21,000. Now, don't get me wrong, $21,000 is a lot of money. I'd love to have it, but I'd rather have 5.3 million or 10.7 million. So what I'm really trying to show here is this concept that you see on the top. It's called the time value of money, or otherwise known as the power of compound interest. Small amounts of money can start to really grow dramatically if you leave them in for long enough. Now, what I want to point out, and this probably ties into the retirement section that you did before, and hopefully is just reinforcing concepts, is, you know, the doubling in absolute value. You know, you start out pretty small. You're only earning, 4 cents, 8 cents, even going from, day 9 to 10, you're only earning, $2.50. But the doublings towards the end are really where the absolute dollar value is changing really dramatically. You're adding 2.6 million, 5.3 million. Those are really important times for your money to double. Now, in order to get to these last doublings, though, you have to start early. Even starting a day late or a year late means that you may be missing out on an opportunity for your money to double, which is why if you started on day 2, you only had 5.3 million instead of another chance for it to double to 10.7 million. And you can see that, if you delay for many years, you probably have to take more drastic action to catch up. So I like to start talking about this because starting to invest early is one of the best advantages that all of you have. Time is a huge advantage. And the earlier you start to invest, whether it's saving and investing for the long run, meaning retirement, or even investing for the medium term, let's say 5, 10, 15 years out, the more time you have for your money to go to work. There was a question that came in around how long do you leave the money in before you can take it out? I'm going to cover that in a couple slides, and the answer is it depends. It depends on what you're saving for and what the goals are that you're saving for. And so the answer is it can actually depend on many different circumstances. It can be a year or two. It can be 50 years. It's going to depend, and I'll show you exactly what it depends on. So the key takeaway number 1 that I want to offer is that as you start to think about investing, and this may not be while you're in school, maybe when you graduate, save early and start to save consistently. Time is one of your most valuable assets when it comes to, kind of generating, wealth and investing. So let's jump into the actual investing piece. And here are a few themes that I want to cover, which is how do I differentiate between saving and investing? What are some of the key terms you should think about? Exactly to the question that was asked, how do we think about time horizon and aligning time horizon with how much risk you should take? A very quick overview of, kind of whether you should go it alone or get help, and how to make sure that you are thinking about investing as a way to meet your financial goals. So before you really start to think about investing in a general sense, I would argue that you need to make sure that you are setting a strong foundation for yourself and saving money for a few different categories. I think you'll talk about this a little bit more tomorrow as well, but one of those things is building up a 3 to 6 month emergency fund. I call this the stuff happens fund. let's say you graduate, you're starting to work, for some reason, something happens, you lose your job. Let's say you own a car or commuting, your car breaks down and you need to repair it. God forbid, there's a huge health emergency with huge health bills. You want to have basically a fund that can help you bridge any of those financial shocks that you're not expecting in your life. Instead of having to resort to putting money on a credit card or begging friends and family for a loan, you want to have that financial cushion, which is a 3 to 6 month fund of enough money that can cover your living expenses. Let's say your rent, food, transportation costs, etc. Before you start to invest, you want to make sure that you're paying off all your high interest debt, like credit cards. I think of high interest as 8% and above. Now, the reason for that is that if we go back to our initial slide, you can see that in the long run, investing, you can expect to earn about 8% on average in a given year when you invest in the stock market. Credit card debt is usually double digits, and usually it can be pretty high. It can be 11, 15, even 20, 24%. You are better off, and it is a smarter use of your money to pay off the high interest debt like credit cards than it is to put the money into an investing plan. By paying off a credit card with 15% interest, you are essentially locking in that 15% gain of not having to pay that interest, which is more than you would expect to earn in the stock market. And then some other goals, which I think you probably covered earlier, so I won't go into too much detail, but making sure you are thinking about saving for retirement, especially if your employer offers a match, and other items. So before you even start to think about broad investing, you want to make sure that you are financially stable and have built up a good foundation by following some of the actions that you see here. So some terminology that we'll cover. Checking and savings account, basically money that you put in there, pretty much protected from loss. And protected up to about $250,000 per account. And so if you open up a credit union checking account and you put in money, that is pretty risk-free. That money's not going to go anywhere. Money market accounts or certificates of deposit probably have marginally more risk, but are usually very, very stable. Bonds are loans or debt that a company or the government gives out as a way to raise money. It's basically an IOU that says, we need to raise money right now. We will promise that we will pay you back, what you gave us plus interest in a year or 5 years, or, we'll give you money back every, every month until we've paid it off. And so a bond is an IOU. The other really important type of instrument to know about is what I think of as stocks or equities. If you own stock in a company, you actually own a piece of that company. So if you own a share of Apple or Tesla, you actually own a piece of that company, albeit a very, 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 very small piece of the company. And mutual funds, something I'm going to talk about a lot today. Mutual funds, instead of buying one individual stock or bond, basically is a pool of stocks or bonds that you can purchase. And the reason you sometimes want to buy the pool of stocks or bonds is that you're not subject to the whims of one individual company, which can shoot up in value, but can also shoot down in value. So I'm going to move on. I'm going to punt a little bit of the question on the financial stability to the end, because I think it'll fit in well and it can tie into some of the conversations at the end or even in the sessions tomorrow, but I will address it. So the reason to think about these is each of these financial instruments, like a checking account, bonds, stocks, mutual funds, can be put on a spectrum of risk, whether there is little risk or whether they're high risk. Here is how I would organize them on the spectrum. As I said, a checking account, if you have less than $250,000 in a checking account, you are essentially protected from all risk. Bonds, there is a little bit of risk, and there's different types of bonds. If you buy a bond from the U.S. government, that's has a lower risk than if you buy a bond from an emerging market that may not be as stable. And then I put stocks as being much higher risk because there's more volatility in individual stocks. Some stocks make a lot of money year over year. Think of a Google or Netflix, other stocks decline in value precipitously, over time, or even companies that go bankrupt and any money that you had goes to zero. Mutual funds, because they're kind of a pool of stocks, have slightly less risk than individual stocks. Now, by the way, there's things that are not even on that you don't even see on this spectrum, which I'll call out, things like cryptocurrency or Bitcoin. I would put that, off the chart or off the slide, if you will, in terms of the level of risk. Now, risk is really important because depending on your risk tolerance and the time horizon that you have, in some cases you can afford to take more risk. In some cases you can afford to take less risk. And you want to choose the type of financial instrument that aligns with your time horizon and how much risk you should be taking. Let me elaborate on that a little bit. So you may have a lot of different goals that you may want to invest for. Some of them may be short-term goals. Maybe you want to, purchase a home or an apartment in, 3 years. Maybe you are thinking about, kind of a medium-term goal of, maybe going to grad school and you want to save for that. Or you may have long-term goals like saving for retirement, or, for some people, a long-term goal may be, I want to put enough money and invest money so that my children or my future children will have their college fully funded. That would be, if you just had a baby, would be 18 years from now. If you aren't going to have kids for 5 years, that's 23 years from now. So time horizon is really important because basically, as we talked about, depending on the time horizon of your goal, you should think about what to invest in very, very differently. So let me give you a couple examples. Imagine that you had invested $1,000 in stock, $1,000 in stock between, call it 1900 and 2000 or 2014. If you needed that money in a year, let's say you had a very short-term goal, you could either be up 50%, meaning you'd have $1,500 if you took the best year over the past 100 years, or the worst year, you could actually lose 27%. You'd be down close to $250 or a little more than $250. Now, that's a lot of volatility. Let's say that you really needed something in a year and you knew that it was going to cost $1,000 or $1,100. You may not want to put it in the very risky kind of instrument like stocks, because in a year's time, there's a lot of volatility and you may not have enough money for the goal that you set out. Now, let's take a longer time horizon. Let's say you invested $1,000 in stocks and you looked at what was the 25-year performance over the past 100 years. So let's say you looked at every single 25-year block, let's say 1950 to 1975, 1960 to 1985. If you took the best 25-year block, you would be up on average 11% every single year. That's really good. If you took the worst 25-year block, you'd be up 8% a year. Now, 8% is not as good as 11, but it's still positive and it's still a pretty healthy return. So what this is meant to show, and I'll show you a different view, is that if you're investing for a longer time horizon, investing in stocks or mutual funds that are made up of stocks are a really good, kind of good bet. The longer your time horizon, you'll see two things happen. One, the gap between the maximum return and the kind of worst outcome starts to shrink. Over a 1-year period, the gap between these two is about 79 percentage points. If you go to a 15-year time period, all of a sudden you're looking at a gap of 12 percentage points. And the 25-year time horizon we talked about, the difference between the best and the worst is only 3 percentage points. So one, the gap starts to shrink. The other thing you'll notice is that the worst possible outcome starts to look pretty palatable. Yeah, you don't want to lose 27% of the money that you put in, but to earn 8% as the worst outcome, I think a lot of us would be able to live with that. And so the longer the time frame that you're investing for, the more you can move into, the more risk you can afford to take, and the more you can think about investing in mutual funds that are made up of stocks or even some individual stocks. The best year to prove this is 2020. The year started off, and this is looking again at the S&P 500, between the first of the year and mid-February, it was up 4%. Looked like it was going to be a great year. And then, as we all know, COVID hit, and the market tanked, lost almost half of kind of the value close to the end of March, and then started to recover a little bit by April, but was still down 15%. And so, if you put money in and needed to take it out in, end of March or April 1st, you would be locking in a pretty heavy loss if you had invested just in stocks. But look, if you actually took a, slightly longer time horizon, waited till the end of the year, the market rebounded and actually ended up even better than, the average of 8%, ended up 13%. And so the longer the time horizon, the more you can afford to absorb these kind of, small shocks that happen over the course of a year or even the course of several years. One other point before we get into some more specifics, don't try to time the market. Some people say, I'll invest and I'll catch, catch it when it's going up, and, I'll know when to sell and when to buy. Analysis over, kind of last 20 years, if you will, or through 2019 shows that if you had just fully invested in the market, you would be up 6% a year. Or if you invested $10,000, you'd have $32,000. If you missed the 10 or 20 best trading days, your returns would drop by more than half. And if you missed more than 20 days, you would actually be losing money over the course of the 20 years. The reason for that, even if we go back to this slide, is that some of the best trading days often follow some of the worst trading days, and they're really hard to predict. You can look at the slope of the line to show kind of how good some of the trading days were. And you can see that, here there's a really sharp decline in the slope, and these were some of the worst days. But then you see really sharp increases in some of the best days. Can any of you really say that you knew that on this day the market was going to, all of a sudden turn and go from, dropping more to increasing more? Not many people can kind of claim to do that credibly. So better off to put money in and keep it in there as opposed to trying to time the market. So I want to shift to a bit more of kind of tactical things, and one piece of advice around where to open an investing account. You may have heard of a lot of these different companies. Some of these are brokerage firms, others are robo-advisors like a Betterment to Wealthfront. My advice is twofold. One is avoid Robinhood. I don't think of Robinhood as an investing app. I really think of it as a gambling app. The way that Robinhood is structured is meant to make you gamble with money. They have very complex kind of instruments around derivatives, options, puts, calls, things that really go beyond the scope that most people should be thinking about when investing, and are definitely not your average instruments. To me, it's kind of just very tempting to take on more risk than many of us should be taking. Instead, I would argue that you should be looking at kind of large, solid investment management companies that help you invest in average mutual funds. So a company like a Vanguard or a Fidelity, or robo-advisors, which are basically companies that use artificial intelligence to ask you some fundamental questions about your goals, your time horizon, and your risk level, and then help to create a portfolio for you. The reason I like companies like Betterment and Wealthfront is that a lot of their underlying mutual fund investment options are those average type of mutual funds that we spoke about. So my suggestion, and again, a lot of research to back this up, we won't get into a lot of it, is that if you are looking to invest in the medium and the long term, focus on mutual funds or something called exchange traded funds, ETFs, pretty similar. They automatically diversify you because it's looking at a pool of different stocks. It's not just one. You don't have to do much work in terms of researching companies. I would steer more towards those as opposed to investing in individual stocks, which are riskier, require a lot more attention and research. If you really want to, kind of play the stock market or gamble, what I would suggest then is put the majority of your investing money into mutual funds, leave a small portion, and treat it as play money. I think that's a fine thing, but I wouldn't use money that is required for that. So what do you look for to know if a mutual fund is good or bad? this is a little bit of kind of just reinforcing the point, a little extra information. For me, good equals index fund, i.e. average funds. These are passive funds. And what I mean by passive is you don't have somebody who's looking to trade individual stocks and kind of make a lot of trades. Really, these are passive, and what they're trying to do is just track the stock market or a portion of the stock market's performance. The good thing about mutual funds that are index funds is they're really low cost. They avoid a lot of the other fees. The opposite of an index fund is called an actively managed fund. And the reason it's called an actively managed fund is because you have an individual or a group of individuals who are actively managing the performance. They don't just leave it in there passively. They actually buy and sell different stocks, trying to juice up the performance of the fund. Because you have individuals who are involved, there's a much higher cost to that than in index funds. And they also often have kind of different fees. So my recommendation is focus either entirely or almost entirely on index funds and avoid actively managed funds. I'm going to give you a clip in a second from John Oliver to reinforce that. This is a study that was in the New York Times from back in 2014. And basically what they took is they looked at actively managed funds that were in the top quartile of performance in 2010, about 2,800 funds. And then they looked at which of those funds actually stayed in the top quartile, in other words, outperformed over the next couple of years. And you can see that at the end, it was only 2 companies that consistently stayed in the top quartile and outperformed. And so their kind of summation was that very few funds achieve consistent and persistent outperformance. And maybe more importantly, there was a strong likelihood for the best performing funds one year to actually become the worst performing funds another year. Even more evidence of why you should aim for average. If you don't believe me, listen to a much funnier individual in John Oliver. Just fun to kind of think through, whether it's through humor or others, the point remains the same, which is aim for average. If you are thinking at some point about getting outside financial advice, using a financial advisor, and as your kind of situation becomes more complicated, as you earn more money, this becomes a real question. We can't get into all the details around it, but I do want you to remember one single word when it comes to hiring help, and that word is fiduciary. My strong, unequivocal recommendation to all of you is only work with advisors or kind of individuals who have a fiduciary duty to you. A fiduciary duty means that that person has a legal obligation, the highest kind of duty of care, to put your interests above anything else, including their own. And it means that they have to recommend things that are in your best interest, not in their best interest. And so, to me, it's common sense. You would want someone that's going to put your best interests first, but a lot of advisors or brokers out there don't have a fiduciary duty. They have, a lower, kind of standard of obligation. And so the ones who don't have a fiduciary duty, if they're working for a company and that company really wants to sell a particular fund and says, to all of their advisors, we're going to run a contest, and whoever sells the most, shares of this fund is going to win, an exotic trip for 2, or is going to win, kind of a flat screen TV. That person can go and sell you that mutual fund, even if it's not, the best fit for you. And so if you decide to work with an advisor, I would only work with advisors who are fiduciaries. On the last slide, and you'll see this, I'll give there are a couple of resources of where you can go about finding advisors that are fiduciaries and that have already been vetted for that standard. The cost of conflicted advice and conflicts of interest from those who are not fiduciaries is staggering, on the order of $18 billion a year. There was a study done back in the Obama administration by the Council of Economic Advisors, looking at the cost of conflicted advice. And what they found was, those recommendations cost Americans and kind of individuals, billions and billions of dollars every single year. So, we've talked about index funds and kind of other pieces. How do you actually go about putting together a portfolio? Because it's not like you're just going to invest maybe in one index fund. And this is a sample portfolio that basically looks to put money in US, kind of funds, both ones that invest in large companies and small companies, some money internationally in terms of, kind of developed economies like the UK or kind of, Western Europe, and some in emerging economies. And then, 10% of the money going into kind of other financial instruments. One thing I want to point out, there's no right answer. These are all, pretty well respected sources of information, all have different allocations for a portfolio, both in terms of the number of different types of instruments that they're recommending, anywhere from 3 to 10, and in kind of the breakout of those. Now, I did want to give one, just piece of guidance here. If you're looking for a very simple approach, again, this is using the two kind of investment management firms that I spotlighted before, Vanguard and Fidelity. No reason just to stick to those two, but just to give you kind of a sense. This is actually showing you how you can build a simple 3-fund portfolio for, let's say, a long-term investment like retirement. Putting, 55% into, US stocks, which would be, let's say, the Vanguard total stock market index fund, 35% into international stocks like the Vanguard Total International Stock Index Fund, same thing with Fidelity, and then 10% into bonds. And so if you're looking for a very simple type portfolio, again, just one example of how you could go about constructing that. I often get a question, which is, you're talking about, all these things, where do I actually go to open up an account? So again, Vanguard, just as an illustrative example, if you go onto the Vanguard's website and you click at the top on open an account, it'll basically take you to a page that says, what's the account that you want to open? And let's say it could be a general investing account that we're talking about, or what you talked about earlier today. Let's say if you're looking to save for retirement, you could click and select the retirement account. And then from there, it would take you through and you would actually be able to pick the types of mutual funds that you want to invest in, how much money you want to put in, and whether you want to make a one-time contribution or have it be automated going forward. Similarly, if you were to go to a robo-advisor, and this is Betterment, again, just as an example, you would say, I want to create an account. It would take you to a page and it would basically say, what's the goal? What are you trying to save for? And going back to kind of, our piece at the beginning. And then it would also say, okay, how much do you want to save? And what's your time horizon? And you can see, let's take the one all the way on the left. Let's say your goal was to create an emergency fund or a safety net, and you wanted to save $10,000 in 2 years. You can see that the recommendation from Betterment would be to kind of create a portfolio that's 40% stock-based mutual funds, the rest in bond-based mutual funds. And you can see that as the time horizon increases, let's say you wanted to save for a child's education. Let's say you just, you're married, you just had a baby, and you're starting to save for that child's college education. So 18 years, and let's say you want to save $250,000. You can see that the recommendation, because your time horizon is longer, is about taking more risk and putting more of your money into stocks as you go through. Now, a question came in. Let me just take a quick read about this. So this is a great question. Let me see if I have it in here. I don't. So question came in around, what's the difference between doing the 3-part index fund portfolio versus investing in a target year retirement fund, depending on the year you plan to retire? Is one better than the other? So the main difference is the target date retirement funds that hopefully I think you spoke about earlier today. Basically, what they do is 2 things. They construct a portfolio, which in some way could be similar to the 3-part fund, but they also do something else, which is they automatically adjust the allocation between the 3 parts as you get closer to your retirement date. So, if you're planning to retire in 40 years, right now you can take on a lot of risk, and a target date portfolio would probably be 90%, if not more, skewed towards stock-based mutual funds. But as you get closer to that retirement date, you don't want to take as much risk because the time that you need the money is much closer. So a target date fund will automatically every year or every 5 years adjust the allocation to reduce your portfolio's risk as you're getting closer to that target date. The 3-fund portfolio that I recommended here, if you do it by itself, will not automatically adjust. You would have to go in and manually reallocate the contribution, every year or every 5 years to essentially assume less risk. And so the real benefit of the target date portfolio is essentially that automated reallocation perspective. This you would have to do on your own, which some people are happy to do. Others don't even want to do that. And so they're, kind of more focused on something like the target date funds, which are set it and forget it. It's a great question. So I do want to talk a little bit about resources, and then I'm going to come back to a question that was asked, and also leave leave a little bit of time for any other questions that come up. Again, we are just scratching the surface here. There is a ton that can be done, that can be talked about this, and I wanted to give a couple of resources if this generated interest in you to kind of learn more. And so depending on your favorite medium of consumption, put a list of books or websites or columnists that I think are especially good, geared towards different audiences. On the kind of blogs and podcast side, those are all really good kind of sources. The other one I'd call out is called Planet Money. There is actually an episode where they talk about the founding of Vanguard, which was founded by John Bogle, and you'll see Bogle referenced several times here because his disciples, basically fanatics of John Bogle, they call themselves Bogleheads, have both written books that I recommend, like Guide to Investing, or have online forums where they talk a lot and talk shop all day about investing. There's a Planet Money episode where they talk about John Bogle starting, the creation of the first index fund, and actually also talk about the bet that Warren Buffett made with Protégé, with some really good interviews and examples in case you want to listen to that. And as I mentioned, on the financial advisor side, if you are thinking at some point about using a advisor and you want to screen for ones that are fiduciaries, either the XY Planning Network or NAPFA, which is the National Association of Personal Financial Advisors, both great resources, because in order to be listed in those networks, advisors have to be fiduciaries. And so that's a good way to kind of stop and vet for that. So with that, I want to come back to a question that was asked and also invite all of you to kind of ask any additional questions that you have. So the question was, how can you make sure that you are financially stable when you are only a college student? Would you say that you need to wait until you graduate to start investing? So it's a great question, great set of questions. When you're a college student, financial stability will probably mean something very different than after you graduate. There are some things that are within your control and some things that are outside of your control right now. Some of you may be 100% focused on your studies. Others may have a part-time job as a way to kind of support yourself. Others may be doing it through loans. So to me, being financially stable in college is probably focusing on a few things. It's really focusing on trying to rein in or not have a lot of credit card debt at all. So not kind of overspending and kind of sticking within a budget that you have. And starting to kind of think about some of those levers around, do you have a little bit of money on the side, for emergencies, things like that. To me, I wouldn't necessarily worry about starting to invest while you're in school. I think you can, but to me, the most important thing is when you graduate, that's when you really start to kind of focus in on, kind of financial stability, and then starting to invest, at the very least, starting to invest for the long term in retirement because of, the compound interest piece. So I don't think you need to wait, but my recommendation is, kind of focus in on some of the more foundational aspects before you kind of go in and think about investing. A couple other questions that have come in. So one question, do I have to open a separate account for retirement and for investing? It's a great question. So I think of retirement, and I think of retirement as a specific type of investing. It's investing for, basically, you're investing for a specific purpose as retirement. You will most likely want to open a separate account for your retirement investing as opposed to general investing. And the reason is, and you may have covered this morning, is that there are special tax breaks that basically the US government gives to individuals to incentivize them to save for retirement. And so some of those tax breaks mean that you get to put money into a retirement account before you actually pay taxes on it. It's called a 401k or an IRA. Those are pre-tax accounts. And you want to put it in a separate account in order to get the benefit of those kind of tax savings. Other kind of investing accounts, like a general investing account, you would want to treat separately from that retirement account because it doesn't get the same tax benefits as well. So yes, you essentially have to open a separate account if you're looking to save for retirement. One more question that came in. So basically confirming, are mutual funds best for medium to long-term financial goals? My argument would be yes. Those are, because it's less volatility and lower fees than some of the other financial instruments. Then the question came in, what about short-term goals? Would a high yield savings account still be the best for short-term goals like saving for a down payment? So I would say, short-term, I would think of as, kind of 1 to 3 years. 5 years and beyond to me can be thought of as, kind of medium term. So the difference to me between long-term and medium term is how you allocate between different financial instruments. Long-term, I would put much more of the money towards stock-based mutual funds. Medium term is probably more of a hedge between bond-based funds and stock-based funds. In the short term, I would recommend kind of more liquid and lower risk financial instruments. So a high yield savings account is a great kind of example of a good financial instrument for the short term. Reason for that is if you're saving for a down payment for a house, and let's say you're saving and you want to buy a house in 2 years, you don't want to take that much risk, right? Let's say you're eyeing to buy a house that costs, $300,000. A traditional down payment is usually 20%, so you would need to save $60,000 for the down payment. A high yield savings account would, give you a little bit of extra money, but you don't necessarily want to put that $60,000 in the stock market and have it be one of the years where you lose, 20, 30% of the money, because then all of a sudden you only have, $40,000 or $50,000, and all of a sudden you can afford, less of a house or kind of a less expensive house. So to me, those financial instruments like a high yield savings account, potentially a certificate of deposit, something that has a little bit of a return, but basically protects your principal, is exactly the type of instrument I would recommend for the shorter term. It's a great question. All right. Any other questions around kind of investing? Again, I think only scratching the surface here. If I had to just sum up the advice